I've done hundreds of TV shows, but there's one topic I've always avoided: the Fed. I know it's important, more important than most stuff I cover, but it's just so complex and dreary. The people in charge even work at being dull. Alan Greenspan called it Fed speak, said he tried to be obscure because he didn't want to spook the markets or tip his hand about the Fed's plans. Bernanke and Janet Yellen are almost as dull. But the Fed is crucially important. It can destroy your savings, affect whether you have a job or a future. I wish there were a simple way to explain what it does, which is why I'm thankful that there's a new film out about the Fed called Money for Nothing. Jim Bruce made the film, and Jim, before we get to your movie, I want to play part of a video made by the Federal Reserve.
The Fed is important because it keeps America's monetary system stable and growing with low inflation, which fosters further growth, which helps keep the economy going in the right direction.
Sounds good. The economy going in the right direction.
You could argue the intentions may be good, but the results aren't always.
And you interviewed Janet Yellen for this film.
Yep.
I chose not to show any of her interview bits because she was even more boring than everybody else. You get the feeling they work at this?
I think since Greenspan, there's been this tradition of the Fed trying to operate, outside of the limelight, behind the curtains a little bit, and not give away its policies.
What I especially like about your film is that it covers the rationale for the Fed, the good intentions behind it, and how those intentions sometimes made things worse. The current Fed was created to reassure people when a bank failed.
Bank customers would become suspicious, and they would want to pull their money out of that bank, and then some other people would be afraid that their bank would go, and so people would want to pull their money out of deposits and withdraw the money as currency.
The banks would not have the currency to pay out, and they would just close their doors.
The Brits have the Bank of England, and the Germans have the Reichsbank. Something has to get done here.
Senator Nelson Aldrich summoned New York's most powerful bankers to an island off the coast of Georgia to secretly negotiate plans for an American central bank. Traveling under false names in a private railroad car, the great secrecy of this expedition would foster conspiracy theories for decades to come.
Why would they use false names?
It was thought at that time, they were worried about, we had two central banks in our country, 100 years ago, 1791 and 1816, and we'd gotten rid of them because there was this sense that they would favor the wealthy and the politically connected.
Your documentary says about 10 years after the Fed was created, its leaders decided to stimulate the economy.
The Roaring Twenties saw the first instance of a Fed-induced boom and bust. At first, the Fed's low rates unintentionally helped fuel stock market and debt bubbles. An alarmed Fed then clamped down, raising rates aggressively in 1928 and setting the stage for a recession and stock market crash.
The current Federal Reserve Chairman, Ben Bernanke, has said, we did it, we being the Federal Reserve. We caused the Great Depression, and we won't do it again.
They've wised up. They've learned their lesson.
The lesson that the Fed needs to learn is that it needs to back out of markets. It needs to allow markets to operate more freely, that the Fed creating incentives.
No, they say we can manage it. We learned from the Depression. We learned from the inflation. We're going to manage it.
It's not that good at managing the economy, that it should play a more passive role.
So they decide the Depression happened because the Fed didn't create enough money. 40 years later, Congress proclaimed the Fed should also fight unemployment. That caused the next crisis, this new mandate, because they printed lots of money, and the extra money caused inflation.
The U.S. had promised to be the world's reserve currency, backed by gold. But the Fed had created far more dollars than it could ever redeem in gold. And now the U.S. could no longer keep that promise.
I have directed the Secretary of the Treasury to suspend temporarily the convertibility of the dollar into gold.
For the first time in history, the dollar was just a piece of paper.
Now, what does this mean for you? Your dollar will be worth just as much tomorrow as it is today.
Over the next decade, the cost of living more than doubled, as the dollar lost more than half its value.
So Nixon was wrong. Imagine that, a politician being wrong. We got inflation that rose up to 13%.
The Fed keeps making the same mistake over and over again. In the 1970s, it was printing too much money. The dollar lost more than half its value in a period of 10 years, right after Nixon made that promise.
Inflation is low today, and recently they had the confidence to do what they've done over the last few years, try to stimulate the economy by printing lots of money to buy treasury bonds and some dubious bank paper. In total, they've spent almost $4 trillion. A dozen people decide to create $4 trillion. They did most of this after the stimulus failed to stimulate.
The Fed upped the ante. With interest rates already at zero, the Fed's only way to juice the economy was to print more money, with a technique called quantitative easing, or QE.
You have what degree of confidence in your ability to control this?
100%. 100% confidence.
Japan's been doing quantitative easing for the last 15 years. So they've tried
They're not
it before.
doing so well.
It just hasn't worked. And I think the problem is the Fed is engaging in experiments, and you know, they're not really letting on to that.
And they get stuff wrong all the time. Here's what Ben Bernanke said before the housing bubble burst.
The problem, the subprime market, seems likely to be contained.
Wrong. And they deny that they basically print money.
Sounds like they're printing money. Nuh-uh.
One myth that's out there is that what we're doing is printing money. We're not printing money.
Is that tax money that the Fed is spending?
It's not tax money. It's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively.
So good for Jon Stewart for getting that one right. But why the line?
They're creating $1 trillion of new currency each year digitally. They're not printing it anywhere, and they're buying.
It's not exactly printing, but they're creating it.
They're creating it out of thin air, which you know shocks a lot of people, but that's the fact.
Are you committing in this interview that you are not going to let any of these banks fail? That no matter what their balance sheet actually looks like, they are not going to fail?
They're not going to fail.
So we got the doctrine too big to fail. It was implied before, but now it was clear, and many people believe that the Fed saved us from another depression. Economist George Selgin of the University of Georgia studies this. They saved us, I'm told.
Well, they didn't save us. First of all, we've had a recession, and a really bad one. And it's now over 5 years since the crash.
It would have been worse if they didn't bail out all these banks and print all this money.
Well, and as a matter of fact, it would have been a lot better, especially if they hadn't bailed out Bear Stearns. That got the ball rolling where all the other financial firms started to take greater risks, the big ones thinking they'd be bailed out too.
And now, too big to fail, we're just stuck with that because they even get to borrow money more cheaply because people assume they're too big to fail.
Yeah, there's no end to this process unless something is done to cut the powers of the Federal Reserve.
So would you abolish the Fed? Some people say that.
I would abolish it as the kind of institution it is today. We've got a paper dollar, so something has to keep it scarce. It's not naturally so. But that could be done by a computer regulating the supply of the stuff according to a simple rule.
What is the worst case scenario if, in fact, we were to see prices come down substantially?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis.
The Fed was the last to really see the crisis coming. And yet, at the same time, they were helping to fuel that housing boom.
So now we're going to get Janet Yellen.
She's not going to be much different than Ben Bernanke. I think, if anything, she might err even more on the side of easy money than he did.
Do you trust these? Inflation today is about 2% a year. Not bad. That means this dollar will be worth probably almost $1 next year. But 2% adds up. Earlier in the show, we pointed out that the dollar's lost 96% of its value since the Fed started. That means it takes $23 to buy what $1 bought 100 years ago. Could be much worse. Inflation was 10% when I started reporting. If that kept up for a century, it would take $12,000 to buy what $1 bought. And if you think that's bad, this note is a $100 trillion bill. It's from Zimbabwe, where idiot rulers printed money like crazy, and eventually even this $100 trillion became worthless. But probably the most famous example of destructive inflation happened in Germany after World War II. Germany lost the war, and the victors, including the United States, demanded reparations. But Germany didn't have any money, so the German central bank, the Reichsbank, started printing German bonds to fund reparations and other spending. Sound familiar? German marks became worth less and less, so much so that soon companies brought wheelbarrows to the banks just to make their weekly payroll. And soon afterward, as inflation continued, individual shoppers would have to show up with wheelbarrows to carry cash to the store to buy groceries. And finally, money was so worthless, people used it for wallpaper. Now, America is not post-war Germany, but might we suffer horrible inflation? Maybe, says the author of Currency Wars, the making of the next global crisis. That's James Rickards. He studies the history of nations that cheapen money. But I assume, James, we're smarter or we're different.
Well, we're not smarter, I don't think, John. You showed some clips earlier with Bernanke saying the crisis would blow over, housing prices couldn't go down. So here's the head of the central bank getting things wrong time after time. By the way, the Fed has one of the worst forecasting records in economics. It's hard to find a worse forecasting record. So I'm not sure how much smarter we really are at the leadership level.
But inflation's low. They're printing all this money. Inflation's low.
Well, inflation actually is low as measured by the government, but we're just waiting for the spark, and it won't take very much. Where the Fed gets it wrong, they think they're playing with a thermostat. You know, if the house is too cool, you dial it up. If the house is too warm, you dial it down. So Janet Yellen and Ben Bernanke say, you know, if this inflation starts, don't worry about it. We'll dial it back down again. But what they don't understand, once the behavior changes, once the spark hits, it gets out of control very quickly. This happened in the 70s, happened in the Weimar Republic, it's happened elsewhere. That's the part the Fed doesn't understand.
And in the Weimar Republic, that's Germany, it got so bad you have a bill that illustrates part of the problem.
This is a 100,000 mark note from the Reichsbank. They were printing so much money, they ran out of ink and paper. They only printed it on one side. You see the back is blank because they didn't want to use the ink. That's how bad it was. They were physically constrained from printing more, so they came up with these workarounds.
People would go out to eat and pay for the meal at the beginning of the meal.
That's right. It would cost 3 times more by the end of the meal, even over the course of an hour or two. So you'd negotiate your dinner bill up front and pay it up front, so the restaurant wouldn't charge you more at the end. There was social unrest. People from the city marched out to the country. They looted farms. They killed cows. They dragged the meat back to the city.
Just to have food.
It was just to have food. It was a lot worse than some of the anecdotes would lead you to believe.
And it led to the anger and the rise of Hitler.
Correct. It fed directly into that. There were, of course, other things involved. But yes, and the thing with inflation or hyperinflation, which is what you get are winners and losers. The winners are people who can see it coming. They have hard assets. Warren Buffett's a good example. He bought the Burlington Northern Railroad. A railroad is all hard assets. It's land, mining rights, rail, etc. So he was dumping dollars and getting into hard assets.
The industrialist does okay because he still has his factory.
The industrialist does okay. The banker does okay because remember, for them, dollars are liabilities, not just assets. Speculators do okay. People who buy gold, fine art, things like that do okay.
Savers get killed.
Good. Savers, people with insurance policies, annuities, retirement income. In other words, the everyday Americans get crushed.
But at the moment, 2% inflation?
Well, a couple things on that, John. First of all, 2% is not benign. 2% cuts the purchasing power of the dollar in half in 35 years, and half again in another 35 years. So an average lifetime is 70 years, and it's only going to be worth a quarter of what it was. But it's 2% for the time being. It starts slowly, but it can happen very quickly.